Great question from Schmulian on the Discord, 15 years old, one of our newest members, asked a question this morning, what is DCA? Vitaly went and gave a pretty good explanation, but we figured this would be a good time to actually get into what DCAing is for those of you who missed the Discord, which by the way, you should sign up for if you haven't. DCA stands for dollar cost averaging. Dollar cost averaging is an investment strategy that aims to reduce the impact of volatility on large purchases of financial assets such as equities. That would be stocks or crypto. Dollar cost averaging is also called the constant dollar plan. By dividing the total sum to be invested in the market, say $100,000, into equal amounts put into the market at regular intervals, 2,000 per week over 50 weeks, DCA seeks to reduce the risk of incurring a substantial loss resulting from investing the entire lump sum just before a fall in the market. Let's have a quick discussion to explain that into English.
And so a stock goes up, goes down, goes up, right? And hopefully it goes up all the way before it crashes down. So lots of stocks do this, and obviously we hope they trend up over time. But let's say you had a limited amount of money and you were like, I should buy this. So you spent $5,000 right here. You thought you were a genius as it went all the way up, as Schmulian was trying to do. And you think you're smart, but then it ends up crashing down. So this can last for who knows how long. A stock can trade sideways or, go up, go even lower than this than we've drawn it. So imagine you broke up those buys. You broke it up here. You did a little bit here. You did a little bit, maybe even close to the top. Then it was falling and you just kept buying it. At some point you run out of $5,000, obviously. But all of these buys, especially when it drops, if you go a little bit heavier, then when you average this whole thing, your average price becomes somewhere there as opposed to all the way up here. To me, it's better if you're not sure, if you have limited funds, to just break up your buys over a period of time, maybe a year, and then your average will be somewhere lower, as I'm pointing out.
Let's look at an example. So Schmulian's looking at Enphase charts. And why don't we just take a look at Enphase's history from 2015 to 2021. So Schmulian said he's got $5,000. Let's just say that you were looking at this at around $9 back in August 2014. So if you bought it at $9.85, now you'll have 507 shares of Enphase. This is what you would have had if you did that. But as you can see, you never know where a stock's going to go. So if you bought in here, looking at the charts, thinking that this was going to continue to go up forever, and you spent your $5,000 in at this point, when it rode up to here, you were at almost double your money. But look what happened over the course of the next few years. Over the next few years, this $5,000 investment of yours would have quickly been eroded, and you would have gone all the way down to 62 cents a share. 507 times 0.76 cents a share, your $5,000 would have been worth $385. So the idea of dollar cost averaging is to spread the money that you have out over a period of time so that you hopefully catch some of these dips as they happen. So you don't care about what the stock price is. You basically buy at regular intervals. You put a little bit of money here, and you put a little bit of money here, and you put a little bit of money here, and you basically keep spreading it out and keep buying. And if you took the $5,000, let's just say, instead of buying it all here, right? Let's say you bought 1,000 here, 1,000 here, 1,000 here, 1,000 here, and 1,000 here. DCA theory says that the average of all of the prices that you bought it here will be more favorable to you than trying to find one particular point and go all in at the same time. As Vitaly mentioned in the Discord, look at them as soldiers. These are your soldiers. They're going to go out to war. And since you never know what's going to happen in war, you always want to keep some soldiers behind so that you can react to something that happens in the market, so that you can spread out your risk and never get caught buying it all the way at the top and then the stock drops on you and now you're either stuck holding or selling it at a loss.
The way I do DCA is not exactly where it's completely even, although that's a good strategy. You just buy every month or something like that. That is
buy
a
every
way
week
to do it.
or buy every month. A lot of people do that more with crypto, I think, than with stocks.
So as opposed to saying 1,000, 1,000, 1,000, I would be like, oh, 500 here, 500 there. And then it drops like a rock. 2,000 goes in immediately. So I up my ante anytime we have massive drops.
Vitaly's saying, let's say that this is where you first discovered Enphase and you go, man, I really like this company. I want to pick up some shares. If you only put $1,000 here, $1,000 divided by $7.40, you would have 135 shares of Enphase at $7.40. But now you have a remaining $4,000.
Those peak prices, you're like, it's kind of pricey, but I'm DCAing. Let me do a little sliver, like
right.
$500.
Because to that point, you never know that the stock doesn't just go straight up from that point. What if instead of dropping here, everyone in the market or Enphase has a great quarter or some great acquisition, stock shoots up. You'll be looking at this price as a bargain, even though it's higher than what you paid for it. Let's say over the next month or two, even when it goes up to $15, you still think it's a good deal and you pick up some more. But maybe you don't put $1,000 in here. Maybe you put $500. $500 at 14.54 would now give you an additional 34 shares. Now you continue to watch Enphase, and suddenly the market turns, and now your favorite stock that you've bought as high as $14.54 and you started buying at $7 goes all the way down to $1.68. Well, if you believe in the company and you think it's going to do great long term, to you, this is not going to be like, oh my God, at the end of the world, my profits are gone. You're going to say, this is a great company that I like, and now it's on sale. You've already spent $1,500 out of your $5,000, so that now leaves you with $3,500.
And this is where I would go harder. Even if it's not only the bottom, this is a big discount now. It's like 20, 30 to 40%, right? What is this? A 50%
So
discount?
it's a big discount now. From this point in time, you see it drop down as 88%. Now it comes down 88%, and the stock is sitting at $1.68. And you started buying at $7.40, and you bought it as high as $14.54. Well, if you believe in the company and you think, oh man, this company is going to do great in the long term, this is my chance to buy it at a sale. At this point, maybe you decide I'm going to spend $2,000 more out of my $5,000 at $1.68 a share. You get 1,190 shares of Enphase.
And you still have some money left.
You've spent another $2,000, so you have $1,500 remaining. It's December that year, and you see it go down as under $1. And you're saying to yourself, oh my God, this is a point when the company could fail, but I really believe in them. And you decide, I'm going all in. And at this point here, you you spend the last $1,500 at 98 cents a share. Now you get a whopping 1,530 shares of Enphase. You're out of money.
So this is really realistic to what I actually do. And even though I don't catch a bottom, as we keep talking on our channel, because what was the bottom on this particular thing? It was like 60 cents, right?
Man, on this one, on the particular one, yeah, the bottom of this thing would have been May of 2017 at 63 cents.
My point is it dropped another 30, 40%.
From there, right.
Me and you and everybody in the Discord is watching, and you're never going to catch the bottom of these things. But if you see good prices, obviously you scale into those good prices and you scale in a bit heavier, at least in my method. The other way is, like you said, you just buy every month and you just keep doing that. But I like to buy harder as it's going down.
Right. Well, look, whether you're buying harder when it goes down or you're just averaging it out, like say you're on a fixed income and you say, I'm going to put $150 each week, whether you're doing it that way because it flows better with your income, or if you get a bunch of money, say 2 or 3 times a year, and that's when you decide you're going to make your purchases. The point is to spread out your buys when you think they're good deals on companies that you like, so that if it is the bottom, you have more chances of catching it. At the end of this whole DCA process, this was a 2-year process here of spending this $5,000. You're left with 2,889 shares of Enphase. We're going to take the $5,000 that you spent and divide it by the 2,889 shares that you now have, and you have an average price of $1.73. That's actually not bad. And let's take a look. This $1.73. When was Enphase at $1.73? Here. So if you look, even though you spent $1,500 above $5-6, $7.40 to $14 up here, because you were able to capitalize on some of these dips, it is the equivalent of you having put the $5,000 in one shot right here. Now, I don't know about you, but I don't think that I would ever be smart enough to be able to catch that and know that that's exactly the right point to put your money in, because it's super close to the bottom. But you can see that using this method of averaging down and paying more when companies that you like go down in price, it brings your overall average down. Fast forward this, if you were holding 2,889 shares today and the price is $126, you would have $364,014.
Look, not all stocks trend down like we just showed, but a lot of them go sideways. They go up, they go down a bit. So Enphase obviously had a big run at some point, but take a look at your chart again. I just want to point it out. We don't know where we are in the cycle. And let's say the market recovers and we go straight to the moon. Well, great. You put in all your $5,000 and you're a genius for this one trade.
Right.
But over the long history of you investing, that's not going to work out every single time.
Well, keep in mind, too, what we've been looking now are the monthly candles. These aren't even daily candles. So this is the price of Enphase over the course of months. If we go to the daily charts on this, it's madness. If you look at the daily chart on this and you're trying to use this DCA method, I mean, even though we know that the price was, look at the amount of up and down and amount of noise that you see in the variation in the price within a day. This is why some combination of purchasing given amounts of the stock over time, as well as keeping some cash on the side, or to use the metaphor, keeping some soldiers on the sidelines to go into battle for you when you see a discount on the ones you love, is a good method.
This is for you, Schmulian. Enjoy it.
Schmulian, happy investing. Oh, good luck, buddy.
Like and subscribe, buddy.